Hey, good morning, ladies and gentlemen. In the name of SIA, we warmly welcome you to today's call. We have had several emails coming that not all of our clients and prospects can join because several things are going on. It's slightly before Easter, there are a lot of conference, etc., etc. So, as always, this event will be recorded. So that's for the ones that cannot join, but also an information for the ones that are here, so that you know that the things are going to be recorded. Now, I would like to start immediately, and I would like to start with a topic that is in everybody's mind. Don't be scared. It's not our main topic we will discuss today, but it's really a theme that everybody talks about. On the left, you have an interesting definition of the different things. On the low, you see here the AI panic is here. You know, for us, it's like always with a technological jump. It's in the theme, it's in the mind of the investors, and it dominates market substantially. Many of you remember that a couple of years ago, everybody was talking about autonomous driving. You know, autonomous driving is here and it's real, but it's not really in the sectors that you would expect to have the biggest impact. Here, it has a massive impact because when you can actually save a driver in Australia, here, example of a Rio Tinto mine, you can save 250,000 Aussie dollars per driver. It has a substantial impact. In bottom line, all this technology will change the world, but it's not usually the most obvious places where you would expect to have the biggest impact. I hope I woke you up a little bit with the first two slides, and I would like now to pass on to the presentation plan and basically to pass on as well the speech to Marcos. Marcos, can you please take over?
Sure, thanks, Alex. Good morning, everyone, to the first call of this year. I'm going to touch the first two parts, so a little bit on the macro case or where are we in the cycle. We always try to understand where we are in the cycle, and then I will talk about performance, but not daily performance or monthly performance. It's going to be more long-term performance. So moving to the next slide, 2023 for us was surprising. We were expecting a kind of a slowdown, even a recession. And look at the chart, you know, the GDP in the US just rebounded, and by the year end, it was around 3%. So no recession. We only saw maybe the UK and Germany a bit more weak, and basically strength in consumer, strength in services due to the help after the COVID, no? From a family perspective, from a household perspective, and also public investing. So that's the picture for 2023 for us. Big surprise from a macro level. So I will touch on the main items that we have been following since the slowdown. So moving to the next slide, slide 6, you can see the picture of last year. Well, not last year, the last 5 years in terms of industrial production. So this is a simple picture where you see that last year industrial production was up almost 7% for China, 1% in the US, and minus 3% in Europe. So we follow closely industrial production because it's more cyclical and it gives us some insight. And in the end, Europe has been already 2 years moving down and negative in 2023. So we are close to the bottom. The US has done better and is slowing down, but still below zero. So it's okay. And China, you know, everybody talks about China, but the industrial production is growing at 7%. So our message here is that global industrial production is probably bottoming out because it takes 2 years normally in a downturn. On inflation, in the next slide, you can see that this time we were right. We are often wrong in our macro perspectives, but in inflation, we were on the spot. So this has normalized. In the end, it was an inflation jump in 22 and 23 due to the COVID help. So fiscal policies, money sent to the families in the US, etc. And now we are back to normal. Just conclusion here is that inflation is back to normal, but we will have higher inflation than in the past decade. So two things that worry us is employment and labor inflation and energy. So we think that it will normalize at levels around 2.5% and 3%. Next slide, I will comment a little on China because everybody talks about China and the risk of China and the growth of China. And you can see here in the picture for last year that everything is okay, excluding property. So it is true that the property cycle in China is in a negative downturn already for 2 years. So, historically, the downturn in China lasts 2 years. So maybe we are close to the end. But it is true that the home sales and real estate investment, etc., in the property is still very depressed. So the message here is we don't think that there is a risk of collapse in the Chinese economy. The government has plenty of tools to manage that, and at some point, property will recover, and with the property, the consumer confidence. So maybe it will happen this year. Maybe it will happen next year, and this is going to be very important for many sectors, natural resources mainly. Next slide, Alex, conclusion. We were happy to see that 2023 was better than expected. We don't really like recessions and the market collapse that goes with this recession, but it was a surprise. We were ready in the year. Couple of comments. One is the strength of consumer and employment, which we think is going to continue, and the new capex cycle that is going to be fueled by supply chain changes, on geopolitics, and also by the energy transition, also by the lack of investment in the past decade. So the base case here has changed. Inflation is under control, so there's no need to raise rates, which means that maybe we are entering in a falling rates scenario, which is a complete change in terms of a stock market. So the question is, are we already in an upcycle or in a beginning of an upcycle? And the response is that we don't know. We don't know, but the indicators are positive already regarding China, inflation and rates. And the other 3 indicators that we follow since the peak 2 years ago, industrial production, EPS downgrades, and global liquidity are already bottoming out or close to bottom out, which means that maybe this slowdown is just very mild, and then we start the new cycle, or maybe is the end of the long-term cycle, right? So basically, to sum up, 2024 we are more optimistic, but still aware that we are still in a slowdown, right? So still things are slowing down. So the message is our 2 portfolios are ready for a good market and for a bad market, and we are ready for any scenario, but still we are more optimistic on 24. So let's move to the next part where I want to touch about performance because we get this question a lot, and I wanted to talk about this just on a long term, and this is easy to understand. The long-term investment fund Classic has done 8.7% per year since inception, beginning of 2002, so already 22 years. You see the 2 falls, the global financial crisis in 2008, and then the 2020 crisis with the COVID. We adjusted the strategy after the global financial crisis, and we'll go through the results after that adjustment. And the message here is, okay, 8.7, a little bit below our target, but with 2 points of positive alpha. So long term, we are doing fine in our view. Next slide, I wanted to touch since we changed the strategy. So we think we learned a lot from the crisis, from the global financial crisis 2008. And we adjusted the strategy, what we call risk-adjusted strategy. Since then, already 12 years, we've done 10%, which is our target. So this, is good to say, and it confirms that we are able to do our target on the long term. We are a little bit below, well below the index, which has been doing 13% per year. And we have 3 items that maybe we have missed a little bit, but it's not an excuse. It is what it is. The leadership of the Magnificent 7 has had a huge impact in the index. Very good performance of value in these 11, 12 years, and very good performance of energy and commodities, where we are invested every time more and more. Final slide is the last change we did in SIA that is important also. So we changed our strategy in 11, and we did the MBO of the company in 2019 when I took responsibility of the fund management, and then we reshaped the investment committee with Alex, Carlos, Urs, and myself. So very flexible, very fast. The Classic has done 11.4% for almost 5 years. which is good. Which this means that we are learning. So 5 years is not enough really to extrapolate, but we are learning. So 9%, 10%, 11%, we are maybe improving a little bit. And I was looking to give you some insight on what could be the potential. And the potential, if you look here to the IRR that we release every quarter, the IRR of the fund is normally around 14.5%. We deduct commissions and fees. We go to 12.5%, 13% potential. We add a little bit for rebalancing the portfolio. We think we can add up to 1 point. So our theoretical maximum is 13 to 14%. So far we keep with our 10% target, which is doubling the investment every 7 years, multiplying by 4 in 14. So long-term and compounding really pay. But we hope that now with the value cycle, we think we are in, and with the commodity cycle, we think we are in. Maybe we will upgrade our targets in the next few years. So that's for the performance long-term, a bit boring, but I think it was important to, at least to say that we are able to marginally improve. I think this is all for my part, and I hand over to the out of the box by Carlos.
Oh, hello, good morning. Yeah, very briefly, I just want to make 1 point. I don't know how out of the box it is, but this is a chart that you have here that you must have seen it 1,000 times for the last few years, which is the difference in performance between the S&P and the European index, which is huge. It is 6 points per year for 20 years. I mean, that's a huge amount of money. And then you can see that if you had invested in the S&P at the end of the crisis, of the financial crisis in 2009, you would have 2.5 more times money than if you had invested in European stocks. For other markets, it's even worse. So, this is, of course, due to many things, and we don't know why. I mean, who knows? This is it. But there are many reasons that one can point out, and one of them very clear, Marcos mentioned it, and I think Alex did, because it is spectacular. It is, as we can see in the next slide, the enormous outperformance of the Magnificent Seven. I mean, the white line at the bottom is the S&P, which looked so good on the previous slide. Well, here it is dwarfed by the Magnificent Six. I didn't put the chart of NVIDIA because if you do, all other lines go to the bottom because NVIDIA has gone up so much that it completely destroys the usability of the chart. It's gone up like, 14 times or something like that. So yeah, these are extremely profitable companies, extremely successful in terms of market price, and extremely large. And this is what's relatively unique. You always have small companies that multiply by 10 because they find something good. But these are not small. These are literally the biggest companies in the world. Saudi Aramco, which is kind of a different thing. But if you take Saudi Aramco, outside, these are the biggest companies in the world. But if you go to the next slide, and this is a slide that it is, or a chart that it is less appreciated. Here, the white line is not the S&P 500 like on the previous slide, but a very interesting index called the S&P 500 Equal Weight. Now, in that index, as the name indicates, the companies are not weighted by their market size, market cap, but they're just 0.2% of the index, all of them. They all have the same weight. That means that the Magnificent Seven, which many people say are the reason for the very high growth of the S&P 500, well, in this white line, the Magnificent Seven are 1.4%, so not a big deal. They could not, they might not be there, and the line would be pretty much the same. So, what this is telling us is that it is not just an easy explanation of an outstanding technological performance, but rather it is the whole US market that it is doing much better. And much better means much better. I mean, again, it's more than 6 points per year. I mean, remember, 6 points is the average return of the stock market. So here you get the average stock market plus another stock market on top of it. In good years, Europe has done 11%, which is much more than the historical norm. So it is truly amazing. and no technology or fancy things here. So what's going on? Well, in the next, again, who knows? I mean, there may be 25,000 reasons for that, and you can talk about the US, the legal setup, how it is a much more capitalistic place, so shareholders are better treated than in other places. I don't know, whatever. According to your ideological bias, you can come up with all kinds of explanations. But what is very clear is that economic growth is faster. Here you see GDP growth. Again, these are the richest and biggest areas of the world. So a difference of 1% in GDP growth for 20 years, well, it's huge. I mean, it is a huge, I mean, Americans are now much, much richer compared to Europeans than 20 years ago. Again, why is that? Your ideological explanations are welcome, but there must be many reasons. But there's something that it is very, very important not to forget. Europe has based for years, actually, for always, since the Industrial Revolution started, on very strong industrial performance. And we can say that certainly on our little home base of Switzerland, but also of the much bigger Germany, Central Europe, etc., etc. Now, if you look at the next slide, this is Germany's industrial production. You see that starting already in 17, so this is much earlier than the COVID and company and the Ukraine war and whatever you want to point out. It's been going down. We are in a process, believe it or not, of deindustrialization in Europe. The core business of Europe, which is chemical industries, fertilizers, precision mechanics, the numbers tells us, of course, the companies are still there, but doing less and less. And what they do more and more outside of Europe. Again, we can give all kinds of reasons for that, and we don't know any of these macroeconomic factors. Look for many explanations. But there is a very, very important thing that people forget easily, which is the cost of energy. At the end of the day, industry is a combination of obviously some investment, so capital, extremely important IP, what you know to do, your technology, your intelligence, your patents, your know-how, and energy. Now, we can assume that capital is not missing in Europe. In fact, we have the lowest interest rates ever, so capital is not an issue. I don't think we Europeans have become more stupid lately. I mean, maybe, but there's no real reason to believe that. So we can look at the next slide and see what's happening with energy costs. Well, this is not the clearest slide. Well, we all know, of course, that when Russia invaded Ukraine, there was a huge spike in the price of natural gas. This is hard to believe, but natural gas prices, when you do the calculation to make it equivalent to oil prices, they went to almost $1,000 per barrel. But that was relatively short-lived because Europe is the richest area in the world which has no energy. The richest area in the world is the US, but they already have energy. So what Europe did is basically buy all the LNG cargos, natural gas, liquefied natural gas cargos available in the world. So that pushed the price down. It froze the Pakistanis, which had started to create an energy network based on natural gas, and they suddenly lost all natural gas because it went to Europe. But we can pay for it in Europe. So that thing was fixed. But look at the two lines down there. I mean, even if they're not very clear, of course they've gone down, but US costs are still 50% cheaper than European prices for natural gas. Now, why is that? Well, why are they down? They're down, by the way, because we have had the two warmest winters in Europe for a very long time. Now, everybody talks about the global warming and whatnot. Well, you may believe that it's never going to be cold in Europe again, maybe. But then it's probably never going to be cold in the US either. So that doesn't change that much. But if we ever get a cold winter again, this thing is going to change drastically. And in any case, costs are much lower in the US. Why are they lower in the US? Because the US produces an enormous amount of natural gas. There is natural gas there. And they produce it. And they produce it even when the price is too low, because the natural gas, well, you do have natural gas wells. And if the price for gas is too low, you can shut them up if they don't produce. But most of natural gas comes out of mixed wells. So when you look for oil, in practically all cases, and more so over time, what you get out of the ground is oil and natural gas. And the natural gas you can't avoid. So if you think that if you can make money just by selling the oil, well, you are going to get the natural gas for free, essentially. And so you are going to sell the natural gas at as long as they pay for the transportation, you'll sell it. Now, that makes the natural gas in the US to be about 2, 3, depending on the moment and the winter, etc. 2, 3, 4, 5 times cheaper than in Europe. This is massive. I mean, 2, 3, 4, 5. I mean, there aren't that many things that are 5 times cheaper in one place. I mean, basic inputs. And that is going up. I mean, that difference. Now, the Biden administration has stopped all export terminals, the construction of all export terminals of natural gas from the US. The official reason is to fight climate change, maybe the case. The direct implication is that there's a glut of natural gas in the US, which is bad news for natural gas producers, and it is fantastic news for anybody in the US who uses energy, who happens to be everybody. So if you look at the next slide, you see the difference in electricity prices. Now, the highest electricity prices in Europe happen to be in Italy. Why? Because Italy makes practically all its energy out of natural gas. Well, they import some hydro from Switzerland, and the rest they do with natural gas. So they have the highest energy prices. Now, how can an industry compete with energy prices which are 6 times higher than those of Canada? And then what happens? That the Italian industry dies over time. And then you can say, this is the way the Italians are, but they also were Italian 20 years ago. So you can go for all kinds of funny explanations, but here you have a pretty clear one. Even Switzerland, which has a lot of hydro, has relatively high. Germany, everybody. Now, in the meantime, what the European governments have done, particularly Germany, is shut down the nuclear plants and start burning coal. Which obviously it's not helping basically anything, neither CO2 emissions nor costs. So if the natural gas prices in Europe are going to be 50%, 60% higher than in the US, well, you can't forget about chemical industry. We're not going to have a chemical industry, and then everything that comes with it. And we better pray for warm winters, because if we get a cold winter, our natural gas prices will not be 2, 3 times higher. They will be 5 to 6 times higher next time. And of course, don't even think about living in Pakistan or places like that, because there you will actually freeze. In Europe, we are losing relative standard of living. We're deindustrializing the continent, but at least we're warm in the winter. So anyway, I think that is an important point. And when we invest, we don't invest in companies. We obviously do not manage the country's energy policies. But when we analyze companies, we must understand the context in which they are embedded. And we're embedded in a difficult, this may change, but for the time being, in a difficult environment for European industry. Okay, and that's what I had to contribute here for today.
Thanks, Carlos. This is Marcos back. I'm going to touch now on the next couple of parts. First, on the long-term investment fund classic in 2023. So we did 9%, 616 euros per share, very close to our target. I remember that our target was 625. Best sectors, you can see it in the slide: cement, technology, health, financials, consumer discretionary. Bad sectors: salmon, farmers, energy, and mining. And you see the best stocks: Pandora, surprise, surprise, 90% increase last year against all odds. The worst was First Quantum. They had problems in Panama. We will discuss that later on. 62% fall in the company. We are concerned about two of our investments in terms of fundamentals. So First Quantum, as we said, because the government has stopped their huge mine in Cobre Panama, and they have declared the concession unconstitutional. Second one is Grifols, that is under an attack by a short seller, Gotham Research. I'm going to dive into Grifols later on. So last NAV now is we are around 640. To give you a little more hope, we are up 4%, a little bit weighted down by Grifols. Next slide is a slide that I used to put every quarter. You see the main position. So with these 10 positions, you more or less understand where the book is positioned. The 4 Gs, our mantra: good business, good management, good balance sheet, good price or discount. And just a couple of highlights from the current positioning of the fund. We like travel as most value managers. So 4 of our companies are being kind of restructured. Grifols, of course, ISS, Reckitt Beckinsale, and Unilever. So this is more or less 20% of the fund. Then Grifols, as I said, is under a pirate attack that I will deal now. We have a strong exposure to salmon. You can see it also in the 10 names here, 16% of the fund. And from a geographic perspective, we are well diversified. US is almost 30%, UK 20%, and Norway almost 20%. So again, the message is good quality book, concentration, and the diversification in the same portfolio. In the next slide, I'm going to go through our expected return. You know that we value every company on a DCF IRR basis, so we can derive what is the return for the fund. So the fund is trading now at 14.3% return. Last price is 640. Intrinsic value 940, so approaching our 1,000 level. We would have multiplied by 10 long term. And this 14% is more or less in the mean. So in the average of the history, the range is between 12 and 17%, which means that the fund is not expensive, it is not cheap. And basically we have the same view on the markets. The SPX, the US Standard & Poor's 500 is trading at 17 times earning, adjusted by the big guys. So it's not very expensive. It is more or less the average historically. And Europe is at 13 times. So we don't see that markets are very expensive. Emerging markets are even cheaper. So the market overall is not expensive. Even technology is not expensive, as we can discuss later on. So the target for 2024, based on multiples applied to this year's earnings, historical multiples applied to this year's earnings, is 690. So we theoretically will have a 12% increase in the fund this year. We also remind you of the target for 2028 because it's a longer term target is more kind of consistent, which is 1,000 euros for 2028. In the next slide, you can see more or less the performance since we started to give guidance 2 years ago. We've been close to the guidance because the markets have been normal, no recession, no panic. So this should be the trend that the fund makes in the next few years if we apply 10%. So these will be our targets. And as said, 2024, 690 per share. Next slide, you can see how cheap the fund is. PE, so this is the average, weighted average of the companies we have, 13 times 2024, compared with the MSCI World 16 times, even yield 3%, higher than the MSCI, price to book 1.9, well below the MSCI. So this is the reflection of the value concept we have. And also it's, you know, it's protection against falling the market, because as being cheaper, we will probably fall less, always from an industrial perspective. Next slide, Alex. I'm going to dive in Grifols, and I will just present the case in 2 slides. One, trying to explain what is going on, and the second slide will go through our view. So on beginning of January, the guys of Gotham Research, they issued a report on Grifols, basically saying that they have issues in corporate governance, in accounting, debt levels too high, conflict of interests, and concluding that the value could be 0. So the stock fell 40%. Now the stock is down 45%, so it's not recovered. So we went through the report, and as we were reading the report, we were more relaxed. And this is important because there's no really new information in the report. This information you find is already public, is already available, audited, and reviewed. So there's nothing new, nothing really to worry about. So, the important thing in our view is that these issues were known already since 19. If you look at the stock price, there's no chart here, but you can look later on. The stock price went down already by 70% since 19 to 23, 24. And the problems were widely known. Acquisitions, too aggressive, conflict of interest between the family and the management, the level of debt was not sustainable, and then the COVID crisis that hurt the EBITDA. So also aggressive accounting, because when you have a ton of debt, you try to be intelligent in terms of imaginative in terms of accounting. But already Grifols initiated a restructuring in 2020. So this is 4 years before the research. 4 years research. Before the research, the management started a restructuring, seeking to change the culture, improve returns, change management, and bring debt down. So, main message here, and this is the important part, is in our due diligence, which is not now, it has been for many, many years, there's no fraud, which is the risk we would have in any of these attacks, because fraud, you cannot look through the annual accounts, you don't understand it if you speak to the company or if you talk to suppliers. Fraud is fraud, and it's very difficult to find. And here, nobody found anything, we didn't find anything, and we've known the company for many, many years. So we are happy here. What is the plan? This is the second slide on Grifols. So there's management changes, the family has left the company. There's a new CEO coming in April, and this new CEO has a long track record in the pharma industry. There's also a normalization in earnings. So earnings were down on the COVID crisis. So the EBITDA improvement is just going back to normal. It's not, a target of taking the EBITDA to a next level. No, it's something that it was already in the past, but the COVID had a very negative impact here. We expect 1.8 billion plus in 24, 2 billion in 25. So then, as debt goes down and EBITDA goes up, the ratio debt to EBITDA will move around 4.5 times 24 and below 4 in 2025. You see our estimates here. Cash generation, very important. We spoke to the company last week, and they made public these figures, between 2 and 2.5 billion free cash flow next 3 years, 25 to 27. This is 750 per year, which means that it's in line with history. There's nothing new. It's 0.3 times EBITDA, cash generation. This has been the historical. There's nothing new here. And finally, the sale of assets. They sold part of the Chinese subsidiary, Shanghai RAAS, already. But the money is going to get here probably by the end of June, and after the approval of the authorities in China. So the deal is done, the sale is done, but still the money needs to come. And this will cut the debt with 1.6 billion euros by mid-year. You can see the multiple, 2025, 7.6 times, return double-digit, price to book 0.7. In our numbers, it's an IRR of 30%. And reserve value 21, the stock price is 6, right? So it's almost 4 times, or 3 to 4 times potential, theoretically. So that's our call. Important message here that I want to give you guys. This is 5% of our fund. So, we don't want black dogs in the fund. Black dogs are these stocks that you know very well, that you have inside, not inside, but very close relationship with the company, that you've been following them for years, that you think you're right, and then you build a 15% position that ends up killing you. We have 5%, so we control the risks, and we are very aware of the protection commitment with the capital we have with all your money and our money. So that's for defaults. If we can pass to the next slide, I'm going to go to the natural resources here. Last year we did 9%, which is good in a year that was, Alex, you can pass to the next. Yeah, exactly. 9% last year, third year of gains. The low in the COVID crisis was 50 euros, and the price at December was 150. So we have multiplied by 3 in the past 4 years. And good sectors last year were mining and infrastructures. Bad sectors were agri-food and energy. And you can see the top stocks and worst names here in the list. So conclusion, 23 has been, a relatively good year, almost at 10%, but fighting against recession. And that commodities do not deal very well with recession fears. In the next slide, you can see where we are positioned right now. So we are giving a bit more detail here. Oil is 25, copper is 25, and salmon is 16%. So you can see here where our main investments are, and I will deal in the 3 topics now. And just the message here is reinforcing again of 4 Gs, even in natural resources. So good businesses, in this case assets, good managers, good balance sheets, and cheap stocks. You see where we focus on scarcity, on safer geographies, near production or in production, no small companies, no majors. And you see the 4 poles of the 4 sectors we are investing. We are trying to find new sectors, and we will do, but they need to be cheap enough. So far, 4 sectors to handle the diversification of the fund: energy, metals, infrastructure, and agri-food. So what's the IRR and the intrinsic value of the fund? We do the same as with the classic, of course. We have valuation model for every company, which means that we have IRR and IV for the fund. This is more complicated because it's based on mid-cycle estimates or convergence. We have an intrinsic value of 220, which would be a mid-cycle estimate for the sector. So for the fund is still well below the mid-cycle, 160. And in the end, a lot of people ask me why the IRR is pretty similar from the classic to the natural resources. And this is the response is because our estimates are converged. So we don't really value the up cycle or the down cycle. We just normalize the numbers, which means that the mid cycle is pretty similar to the sector and to the market, right? I think we think that we are in a long-term up cycle. As you know, we expect double-digit growth per year here, and the target is to reach 300 euros per share in 5-6 years. And I will give some comments on that later on. You can see the valuation of the natural resources fund now, 11 times earnings next year, which is cheap, but it's in line with the natural resources that they are trading cheap. Dividend yield 3.5%, 4% next year, which is interesting, very high dividend yield, because there is a discipline now in the sector that in the past we didn't have. They are not investing as much as in the past for good reasons. And then the price to book, I can tell you very broad signs here of historical. This sector historically broadly trades between 1 and 3 plus price to book. So when the market goes very, very kind of bullish commodities, you go to 3, 3.5, 4 times book. If you take the book of 2025, which is easier, 100 euros, and you multiply by 3 or 4, this is our target midterm to reach 300 plus. And then I'm going to touch the 3 main investments to give you some fundamental background on why we are so overweight here. In terms of oil, I'm going to go through 2 questions that are very important. First question, has shale peaked? And you can see in the chart the estimates from Bernstein. Shale oil in the US is now producing around 10 million barrels a day, with the rig count stable, even down last year. So we think it has matured. There's 3 plays that are big in size: Bakken, Eagle Ford, and Permian, and only Permian can grow. So the chances of growth are slowing. And then there's a sign that makes me more confident on this, is that the last year the consolidation of the sector was huge. So we saw like 6, 7 deals in shale, which normally is an indication that the companies do not see much more growth, want to consolidate CapEx and OpEx. So, we are quite convinced that at least we will not have growth from this, and it has been most of the growth of the past decade. The next question I will ask you is, do you think that people are going to invest more in oil? You can see in the chart that since 2016, and you see the red part of the chart, the underinvestment. This is basically $75 billion per year. If you add up more than $500 billion in the past decade of underinvestment. So this short term has not a huge impact because the fields take a long time to mature, which means that we are living from the exploration and findings of the past 2 decades, but it's gonna have a huge impact long term for sure. Demand keeps growing, and this is something that a lot of people find difficult to understand. Demand keeps growing. So this year estimates go from 1.5 million to 2 point something million from OPEC. But the most important thing is going to be 7, 8 million from now to the end of the decade. So we put here 7 million more to 2030 to be conservative. But the question is, who's going to invest in this? I mean, who's going to invest in oil when everybody fears about peak oil in terms of demand, so peak demand, and then everybody fears on ESG and pollution and CO2, which means that, where do we get the next 10 million? Where do we get the next 10 million and at what price? And this is going to end up in tears in our view. Then I will move to copper. Copper is even easier. You see here in the chart, thanks to Bernstein again, the estimates in demand that this is going to be probably much bigger, but whatever. So if you take the demand from 2020 to 2040, only 20 years, demand will grow from 30 million tons now, including recycled copper, to 50 million tons in 40, which is 20 million tons more. So to give you really an image here is 60 Cobre Panamas, 60, or 50 Kamoa-Kakula mines that are massive, massive mines. And then they shut it down on resource nationalism. So, it's very easy to understand that demand is going to accelerate from 0.5 million tons per year to 1 million tons per year growth in the next few years. We are going to electrify everything. And then we'll go to the supply side, and you'll see what the difference is. In the next slide, you can see what happens. Well, it happens that a copper mine takes a decade to build. It happens that the current price is not enough to build a mine. It happens that ESG is against mining and tax is against mining, and there's resource nationalism like in Panama. So you invest $10 billion in Panama, you start producing copper, and then the mine is closed. So imagine the impact in the cost of capital is massive. So, and then resources are all not the existing production, but resources are mostly in high-risk countries. We are talking about Congo, we are talking about Zambia, we are talking about even Peru and Chile with the recent changes. So, if you look at this, we are moving to structural deficit. And the thing is, with the closure of Cobre Panama and with the profit warning of Anglo that reduced estimates last year, the deficit is probably already here. So BHP said that they see the deficit by 25, but we are in 24, which means that the market is going to start thinking about the medium term and to see how this is solved. And in the end, the problem is that even if we start investing now, it's going to take 10 years at least. So that's for copper. And then on salmon, final 2 slides on the sectors. So you can see here the biomass in the sea in January 24 for Norway. Norway is producing 50% of the Atlantic salmon that we eat, 50% share. And the biomass in the sea is down 1%, which means that we will not see growth in 24, we will not see growth in 25, because the biomass is taken out in the next 18 months. Why? There are biological issues, there's higher temperatures, you need licenses. In the end, long-term growth is going to be low single digit. And at flat prices, demand grows 7-8% on historical statistics, which means that the only factor that can adjust this is price. In the next slide, you can see the same chart for Chile. In January, it was down 7%. And this is the second producer in the world with a 20-25% world share. So which means that the 70% of the production is in negative in January. Yeah, the same story, very difficult to grow. These prices will be much higher. Prices will try to incentivize other ways of producing salmon, like onshore or offshore, but this is going to take a lot of time. We think it's an excellent sector to make some money here. This is why we have invested a big chunk. So that's for the salmon. Conclusion. We still believe in the super cycle. We are more selective, okay? So we are now more selective on changes. If figures change, we need to change. So our preferred commodities are oil, uranium, copper, and salmon from the food angle. Uranium, we think, we are convinced that it has already moved to a super cycle. So there's no supply this year, there's no supply next year, just companies are bringing back idle capacity and prices need to stay high in order to find green fields. So yeah, it's going to be a long cycle for uranium. Copper, as we try to explain, will join the structural deficit probably this year or next year, depending on how fast China recovers. So China will be the trigger here. If China has a good 24, boom, copper will go to 5 or 4 more. And then the oil market, as we discussed, needs to find a new shape. So good luck, good luck. So just to be a bit bullish here and you know, make us a bit more happy today, if we apply the pendulum theory or the mean reversion theory, going to the low of the fund in the panic of COVID, we reach 50 euros. Intrinsic value now on our numbers to 20, which is quite consistent because it's a bunch of assumptions between more than 40 stocks. And then the upside, what would be the upside? Applying the same variance would be 390. So let's be happy and enjoy the ride. Next slide, final, I think it's final for me. Just a comment here. If you look at the correlation of natural resources with the rest of the market over the long term, this is a very interesting sector because not only it is cheap and the upside is big, as we try to state, but it is well decorrelated with the market, which is another extra to the attractiveness of the sector. And I think that's it for me. I hand over to the natural resources thoughts by Urs.
Thanks, Marcus. Just a few words from my side. I don't want to get too long on these long-term things, which we have heard this many times about underinvestment and so on. And of course, this is long-term, meaning it has not an impact immediately on the short-term or the shorter-term price movements. And shorter-term in our business is maybe 2 to 3 years. But still, I found some interesting charts. Glencore is always good charts. Here is the energy market, which you expect going from at the moment. What is it? 27,000 terawatt hours to 42, meaning that's more than a double of the energy market within the next 10 years. And obviously, Carlos elaborated many times on this, on the golden billion. I mean, that's not Carlos who said the golden billion, that's Putin who says the golden billion. Carlos, being politically more correct, names it the lucky billion, but this is the lucky 1 billion people who have the 70% of the energy consumption, which means us. And we have often elaborated what it means when the rest of these emerging markets, all these hugely populated countries, want to have a higher standard of living. What we have seen in China in the last 20 years, it's going to be India, Southeast Asia, and so on. And on the long run, what it means for example, copper, what Marcus said, I think that's quite an amazing figure, because of course, the more this alternative energy which you add to the infrastructure, which is mostly wind, a big difference to the old economies that in coal, for example, you build the power plant close to where the power is needed. But for example, wind, the power plant is where the wind is blowing. And this is often very far away from the demand. So there you have a huge increased demand for grid and transmission expansion. And for example, the estimate is that you will have to add 80 million kilometers of grids till 2040, which is doubling the existing grid. I mean, this is a huge figure for the next 15 years. And of course, then you need some cables for that. So there's a reason why we have the two monopolists of high voltage cables in our portfolio. And of course, it needs a bit of copper. How that should work without mines, we don't know. And maybe on the right-hand side, it's quite interesting what really the real world is. China has added terawatt hours by source. And you see, I mean, they're adding nuclear, but this is very small because it's a small industry. Then they added a huge amount of wind and solar. But if you compare it to how much it has been adding in coal, I mean, that's gangbusting, and that's the real world. So, you know, so much for the people who claiming it's the end of coal or the end of oil on all this rubbish, because that's completely ridiculous. Because if you need energy, you need the sources which would produce energy. Okay, maybe the next slide, Alex. I want to explain a bit the short-term movements. This is the price for copper. Marcus mentioned uranium. I mean, we reduced our uranium exposure, particularly Cameco, because it became too expensive. And you have a lot of idle capacity, which is coming back now, which is a huge amount. So in uranium, it's the amount in size like in oil, Saudi Arabia, Russia, and the US coming back to market. And this is a bit something what we have seen, for example, in the base metals 2 years ago. You see the copper price, if you have a 10 years bear market, prices are so low at the bottom that you have a lot of idled mine and so. And then you get a price increase, you know, that was in copper from 2 to 5, which is quite a lot. And then what happens is, you know, you remember you had this screaming of transition metal and the supply chains. And if the price goes up, there's overconsumption because everybody builds inventory because everybody's afraid of not having enough inventory. It builds up inventory through the whole supply chain in the industry. And there's in addition speculative positions, investors who also build inventories. And of course, if a price multiplies by 3, then you have some additional capacity coming back because mines who were not economic at 2, they are economic again, and then you have marginal production coming back. This happened in the base metals 2 years ago, and then you know you have overproduction, inventories being released, and you have also an economy which, by accident or not, is in a recession industrial-wise. And copper prices, like many base metals, have been going sideways or consolidating. By the way, they're now breaking out in the upside big time, so we're not chartists. But if you look at this chart, obviously that looks very bullish. If you take other base metals like nickel, zinc, it's even more extreme because the volatility has been extremer. But we are having reached price levels in base metals where the marginal supply disappears, like Marcos said. On the next slide, Alex, that's maybe a good illustration. And you know, this copper price is not extremely low, but still with recent costs, this is the production estimates for copper for this year. In the last 12 months, they have fallen by 1.4 million tons on a total production of 22. So this is more than 6% of production, which the estimates have fallen because you have marginal mines that are being closed or the problems with Cobre Panama, investments which are being cut. So this shows exactly that base metal prices are too low. The marginal production is disappearing. And this is always the right time to buy them because they have to go up because obviously the demand is going up. Inventories, as you see on the right-hand side, they are very low. They have been reduced in the last 2 years. And this is the reason why these metals are breaking out on the upside. And we think it's a very good timing moment for increasing the exposure to that sector, what we did, for example, in the last weeks, months, reducing, for example, cement, but also uranium, maybe a little bit of oil. And this is an interesting chart. Now I want to come to the investors. You know, we have a lot of meetings and Alex drags me around all Europe, feeling sometimes more like an influencer or being in an entertainment business than in the investing business. But this is an interesting chart about the sizes of our markets in metals. So you see the iron ore business is 2.6 billion tons a year. If you would add other mining products, cement is 4.1 billion tons, oil is 4.4 billion tons, and coal is 3 times higher than iron ore. So these are the big bulk commodities. Then you come to the middle commodities. You see, copper is relatively big, much bigger than zinc, much bigger than nickel. Aluminium is big, but it's not really correct to show aluminium because it's processed product. It should be bauxite, but we leave this away. And then on the right-hand side, you come to this small metal, you know, the technology metal, precious metal, and so on. And the interesting thing is, when we visit clients, they all want to invest on the right side. They want to invest, they all own precious metals company, and these fancy metals and things nobody knows anything about because it goes up because of some new technology. Now, I want just to give you a few examples because people don't even invest in the companies who produce this thing on the right-hand side, only in companies which claim they will produce it in the future. And it's never going to happen. Because if you take in these industrial metals, the right-hand side, and you say, obviously, there's uranium. There is a thing like beryllium. Nobody probably knows that. The biggest beryllium producer in the world is Kazatomprom, which we own. You have to buy this company because it's a byproduct. Moving to the right-hand side, all this fancy thing. Molybdenum. Molybdenum, the biggest producer is Peru. It's mostly a byproduct from copper. So Antofagasta, Codelco, Freeport-McMoRan, and so on. Then you go to cobalt. If you want to have cobalt exposure, you have to buy Glencore because cobalt is a byproduct of its huge copper operation in Katanga in the DRC. Vanadium. If you buy vanadium, it's a byproduct from smelting. You have to buy Glencore's chromite smelter Merafe, or you have to buy Evraz, the Russian company, because it's the biggest steel producer in Europe. You can't buy it at the moment, unfortunately for you. You go to other things. Silver is a byproduct from zinc lead or copper gold. Gallium, which is mentioned here, gallium is not being a byproduct. It's being produced out of red slag from the aluminium industry. So the biggest producer in Europe is Rusal, or you have to buy the Chinese. Tantalum, again, you have to buy Kazatomprom. It's the biggest tantalum producer in the world. So a lot of these investments I do see people doing, they are here, but they are not really even investing in the companies who produce it, just in some strange companies who have a project and claim they will produce it into the future. I can indeed guarantee you most will never produce. It's worthless. It's worthless. But they are all investing on the right hand side. All investors we see, they have gold shares. And now what I'm going to say in advance, don't get me wrong, I think it's a very bad moment to get rid of your precious metals company. Gold is breaking up on the upside, and gold companies, they are going to double probably. They are far too cheap at this stressed level. And people come to me and say, Urs, why is this so bad, this Barrick, etc. But they shouldn't complain with me because I explained this many times, but nobody listens, not even my wife and my daughter. But I go to the next slide, quite an interesting comparison. This is very interesting because on the slide before, Alex, maybe you could go back just for a second. In tendency, the commodity prices tend to go up more on the things here on the right. The scarcer things are, the more prices go up. The more abundant things are, the less prices go up. This is the reason why people invest here on these projects on the right-hand side. But the next slide, Alex, this is an interesting thing. And I know these comparisons are always, you know, when do you start it and the exact moment. And I'm not too good in this Bloomberg. I just try to go back as long as possible. It was not able to go back longer because of ticker changes. This starts from 97. So by far, the best investment you could have made is BHP Billiton, which is producing iron ore and coal. And for example, C&Q, a Canadian, one of the biggest three Canadians we own in the fund. I mean, you made more than 3,000%. So much to the people who claim you never make money in the investing business in commodities. Then the blue line is Berkshire Hathaway, which is doing this 10%, like us, more or less. And it seems 10% is not that bad because Warren Buffett seems to be the biggest investor. The white line is physical gold, which in my opinion is a very good investment with 7%, in my opinion, without risk. And then the blue line, the green line is British Petroleum, which is a disastrous company, horribly managed. And Carlos claims British Petroleum, nor petroleum, neither British. Another topic. And then the last one is the gold equity index. And you know, over the long term, you virtually are flat with gold stocks or precious metal stocks in times when gold was probably the best commodities. and multiplying by 10. So there is a correlation, and it sounds paradox. The more the commodity price goes up, the worse is the performance of the producers or the ones who claim to produce it. Now, why is that? Because you would expect a commodity price going up would be good for a mining company. But the problem is, if something is scarce, and I'm a bit cynical and say you don't have anything to mine, that's the reason why it's scarce and why it's go up. So you don't make money if you have nothing in the ground to dig out. And for example, in the mining industry, if you look at the real costs, you should look at, for example, what is really the operating cost. It's not the cost per ounce or per ton. The cost is per ton of earth you move. Because if in Australia, an iron ore mine or a gold mine, you know, there's no difference in terms of cost per ton because everybody wants to have the same salary. The guy doesn't care if he works for iron ore or for gold. Caterpillar doesn't care if it's used in a gold or iron ore mine. The diesel is the same price. But the problem is if you have like a commodity which is abundant, let's say coal, I mean, it's pure. You only wash it. Iron ore is worthless dirt from Australia and so on. But the problem is if you have something which is scarce and you might have 1% grade, and after 2, 3, 4 years, that's why it is scarce, the grade goes down from 1 to 0.5. This is the same like the gold price going down from 2,000 to 1,000. Or you have huge capital-intense businesses which you need to depreciate. And obviously the biggest cost in capital-intense business is depreciation. Now, if you have mining business or oil industry, which has 50 years mine life, you produce forever. You know, the oil industry conventional is producing since 60, 70 years with all the problems. So you can depreciate. But if you have a scarce commodity, which after 4 years, they say, you know, we go underground from overground, you know, but the cost per ton moving earth from underground from open pit to underground, it multiplies. So there is a reason why you have these huge differences in performance. And I would just suggest to people that now maybe in a year's time, when this scarce, for example, the gold companies have performed very well, I don't think it's the right asset allocation just to have the whole commodity business in these producers of scarce commodities like precious metals, like platinum, etc. Because if you really look at the correlation, the money for miners is like the thing shows, is on the left side with the abundant thing. It's in cement, it's in oil, it's in iron ore, in coal, etc. And so I would just want people to consider maybe in 2 years' time when we have a good rally for example, in the mine, the gold companies, which I personally own as well. But I think it's the wrong way to have the commodity exposure just in such projects or some strange tantalum projects and vanadium. But I think really the money is being made in these abundant things structurally for the shareholder. That's from my side, Alex.
Thanks a lot, Urs. Actually, we would like to move on to questions. We have received a question by email and another one on the chat. We know that we already passed the magic hour. So basically, I think we summarized the questions that we have received. People want to have more info. Marcos, how do we see the Grifols case actually to evolve or to be resolved?
Okay, yeah, there's a couple of questions on Grifols. One was on governance. So governance. So we know the company for a decade, and we've been dealing with them for these many years, and we knew that they were a conflict of interest. It's a family company, and they were kind of not managing well the difference of the difference between the family and the company. And then they went in an acquisition spree, too aggressive, and then the debt level went up, obviously, and then the virus crisis, the COVID crisis. So the whole thing went in the wrong direction. So in terms of governance, we understood and we knew that there were problems, but also the management since 2020 said clearly that they were changing, that the company would start a restructuring process. I'm talking about 2020. And you know, things are not white or black. They've been doing things maybe too slowly, and now obviously with the research of Gotham, they are accelerating to the fight to complete all the changes, right? So that related to the corporate governance issue. I'll tell you what is the process for this year. Accounts have been released with no qualification, so the accounts have been released by KPMG just a couple of weeks ago, and they are clear. Number two, new CEO. He comes in April. He has a good track record. I've been receiving information from him, which is positive. Then we will have the report from the National Commission on their investigation. It's like the BaFin in Germany. They are now in Spain investigating the company. The information we have is that it's going to be okay or good. Then we will have the first quarter results in a couple of months, which we checked, and they are on track. Then we will see the money from Shanghai RAAS coming to the company by the second quarter. They said end of the second quarter. They need the okay from the Chinese authorities, but here there's no cartel or oligopoly or no, it's just the bureaucratic process because the buyer is not in the industry. So there's nothing that can stop this. So they will, and then they will pay back debt with this 1.6 billion euros they will get in June. Paying back this debt, they will renegotiate or refinance the company, but it is a minor amount. In our view, it's going to be like 600 more to refinance out of a total debt now, net debt of 9.4 billion. So it's easy to refinance, and then they are set for the next 3-4 years. Then what else? 2024 results with 1.8 billion EBITDA. And that's the pace we see, because again, we didn't see any new info in the research of Gotham, and we are convinced this is not a fraud company. Why? Because, you know, the business is very, you know, it's a pharma business. They are audited by the FDA, by the European regulation also, so the European FDA. So all the installation, all the fabs, everything is being monitored by the authorities because the product is a pharma product. We are talking about blood proteins, and they've been clean for 100 years, which means that in the end, our conclusion is that all this has been mismanaged because of a family-owned company becoming more professional or market-oriented, and, you know, with a COVID crisis and too much debt. But it's not, in our view, a fraud. The other message is clear. We want to protect capital. So we are extremely convinced, but we will not go and build a black dog on this. So Clifford will move around 5, 6, maybe 7% if the stock goes up of the fund, maybe a bit more if the stock doubles fast, which is not our scenario because these things take time, but we are very optimistic. Be careful on investing only on one stock. This is a part of a portfolio. If I would now reclassify the risk of defaults, it would be a category 3, even a 4. So it's not for investing 100% of the money due to risk. Debt is risk, but we have a high conviction it's going to be an important part of our portfolio. Alex?
Mute. Yes, sorry. We have another question on Shell potential in Argentina. We know we actually are already over the time. Maybe a very brief answer. I don't know if Urs or Marcos.
Yes, I think I could answer this. You know, this Vaca Muerta in Argentina is probably the biggest shale deposit outside the US. And in the peak of the oil industry, there was a big hype. Everybody was invested, and you know the future and so on. At the moment, I think it produces 300,000 barrels per day, some gas, so it's relatively small. And of course, in 20 years, it's probably going to be a relevant oil industry when the oil prices are high. But of course, like everything, it would need investments, and let's see how Argentina develops. But at the moment, nobody invests. And, you know, for example, Exxon is just considering selling their stake in Vaca Muerta for around $1 billion, which is nothing. So I think this is not going to be a substantial provider. Of course, from 300,000, it's relatively easy to go to 600,000. And this will happen when oil prices are going up, but it will need investments. And so who invests in Argentina? Who invests in energy, as we have seen? So I don't think that's something for the next few years. That's maybe if you're a young guy and 20 years old, I think you would recommend somebody to go there, because 20, 25 years, that's a very important, you know, maybe 3-4 million barrels per day oil probably, with oil prices at 200 or 300. But I think for the moment, this is not a big thing.
Hey, perfect. With that, I would like to thank you all that were staying with us until actually a quarter past an hour. Thanks a lot. We'll have a lot of things coming up. We will be at the Fund Fair in Zurich. We will have our Swiss Valley Day, and we will have our Natural Resources Day in autumn. And the first event we're gonna come to Frankfurt to do our annual presentation there. Take care, have a happy Easter, and we'll see you soon. Thank you. Bye-bye.